Welcome back. All right, today was not a victory lap. This was not one of those sessions where you look at a green close, lean back in your chair and say the market is clear, the risk is gone, and the next move is obvious. That is not where we are. What we got instead was a reminder that a market can rise a little, look better on the surface, and still remain trapped between hope, fear, headlines, oil, yields, and some very stubborn resistance overhead. So yes, stocks finished higher. Yes, the tape looked calmer. Yes, some very strong names kept acting well. But no, this is still not the kind of action that gives serious investors permission to get sloppy. And right after this opening, let me say one thing quickly and professionally. YouTube stats keep showing that many people watch these videos, but still are not subscribed. So if you genuinely get value here, subscribe now and drop a short comment, even if it is just Our John AG, because that support tells both me and the algorithm that this content deserves to reach more people. Now let's get into the real story, because the real story is not that the market was up. The real story is why it was up, how much it was up, what still has not happened, and what could go wrong very fast if people get too comfortable too early. Monday's session came right after the long weekend, and that matters. U.S. markets were closed on Good Friday, April 3rd, and when trading returned on April 6th, volume was still on the lighter side. That matters because light participation can make a green day look cleaner than it really is. A move can appear healthy, but without broad conviction behind it, that same move can run into trouble the moment fresh pressure shows up. And if you look at the close itself, the gains were respectable, but not explosive. The Dow finished up 0.36%, the S&P 500 rose about 0.44%, and the Nasdaq added 0.54%. That was enough to keep the rebound attempt alive. It was enough to keep people interested. It was enough to keep watch lists relevant. It was not enough to settle the bigger debate. Because this is the part that matters most. A market can be green and still be fragile. A market can climb and still be under pressure. A market can look better and still be one ugly headline away from rolling over. And right now, that is the exact kind of environment we are dealing with. The S&P 500 and the Nasdaq have managed to push themselves back above shorter-term trend levels, and that is constructive. It tells you buyers have not disappeared. It tells you the tape is trying. It tells you the market does not want to fall apart right here. But the bigger prize is still missing. The stronger confirmation is still missing. The clean message is still missing. Because what do you still want in a situation like this? You want follow-through. You want a stronger move. You want the indexes to prove they can do more than simply bounce after getting stretched. You want them to fight through heavier resistance and hold it. Until that happens, what you have is a rally attempt, not a fully trusted move. And that difference matters a lot. Because if you forget that difference, you stop preparing and start guessing. And guessing is expensive. Now, let's widen this out. Why is this market still so tricky, even though stocks have put together a string of positive closes? Because the market is not trading on one clean theme right now. It is trading on a pile of moving parts that do not always agree with each other. There is the war backdrop. There is the Iran headline risk. There is the Strait of Hormuz issue. There is oil. There are Treasury yields. There is inflation pressure. There is the question of whether traders are pricing in relief, escalation, delay, or another round of uncertainty. That is a lot. And when a market is being pushed around by that many outside forces, you have to respect the possibility that two opposite outcomes can both look reasonable at the same time. That is where we are right now. On the one hand, investors are clearly seeing some path toward reduced tension. Reuters reported that stocks edged higher as markets weighed negotiation signals around the U.S.-Iran conflict, while oil settled above $112 a barrel and the 10-year Treasury yield stayed near 4.34%. In other words, equities were trying to stay calm even while the broader macro backdrop was still carrying pressure. On the other hand, that same report also makes the problem obvious. The problem is that oil is still elevated. The problem is that headlines are still driving intraday emotion. The problem is that traders are still reacting to every new signal as if the next update could change the whole map. That is not the same as a calm, clean bull move. That is a market holding its breath. And if you want to know why I'm being so careful with the wording here, it is because this is exactly how people get trapped. They see a few green candles, they assume the danger is past, and then they discover that the market was never really trading on technical strength alone. It was trading on a temporary reduction in panic. Those are not the same thing. Now here is where it gets even more interesting. Normally, if oil is moving like this, you would expect stocks to feel that pressure more clearly. You would expect investors to worry harder about inflation. You would expect growth concerns to show up faster. You would expect the market to act like expensive energy actually matters. And maybe that still happens. Maybe the market has simply not reacted fully yet. Maybe the market is waiting. Maybe the market is choosing optimism first and consequences later. Because we have seen that before. A headwind gets ignored, then suddenly it matters all at once. It looks harmless until it is not. It looks manageable until something breaks the mood. That is why I do not want anyone watching this to confuse "the market is handling it" with "the market has solved it." Those are not the same sentence. At the same time, there is another side to that argument, and you have to respect that too. What if oil cools down fast? What if a positive geopolitical surprise hits? What if the tension premium comes out of crude quickly? What if the market is actually looking a few days ahead and saying, "We have already seen the worst part of this particular scare"? That is possible too. And this is exactly why I keep coming back to the same phrase: range of outcomes. The range of outcomes here is still wide. Too wide for arrogance. Too wide for oversized bets. Too wide for emotional trading. If both the bullish case and the bearish case still sound believable, then your edge is not as strong as you want it to be. And when your edge is not strong, discipline matters more than excitement. That does not mean you do nothing. It means you do the right things. You prepare, you observe, you rank leadership, you build watch lists, you stop pretending that every green day deserves heavy exposure. That is the difference between wanting action and wanting an advantage. And since a lot of people keep asking what the smart move is in this kind of market, here is the plain answer. The smart move is not to force certainty where certainty does not exist. The smart move is to get ready without getting reckless. The smart move is to know exactly which names you care about if the market improves, while also knowing that headline risk can still hit the indexes faster than your conviction can react. That is the job right now. Now let's talk about the one part of the market that actually looks better than the indexes themselves, because this is where the conversation becomes more useful. Individual stocks are giving better clues than the broad market. That is important, because when the indexes are messy but certain leaders keep behaving well, you do not ignore that. You study it. Why? Because if the market does eventually confirm, the names that held up best during uncertainty are often the first ones that become actionable. And that is what we are starting to see. Not everywhere, not in every sector, not in a way that gives you permission to throw caution away, but enough to matter. AI infrastructure is one of the clearest examples. And no, I am not talking about the usual overhyped software names or the crowd simply chasing any ticker with 2 letters attached to the AI theme. I am talking about the less glamorous side, the plumbing, the power, the cooling, the equipment, the things people forget when they only focus on the flashy story. Because data centers do not run on excitement. They run on electricity, cooling, distribution, physical build-out, and real capital spending. That is why names tied to that build-out have been so interesting. Even in a nervous market, several of these stocks have not acted broken. In fact, some of them have acted like they barely noticed the correction at all. Not perfectly, not without volatility, but compared to the broader market, very well. And that matters. Because when a stock refuses to fall apart during a shaky tape, it is telling you that real sponsorship may still be there. That brings us to one of the cleaner examples, comfort systems. Now look at what makes this kind of name stand out. It is not just that it rallied before. It is not just that it is tied to a hot theme. It is that after a major run, it actually tried to behave like a serious leader. It did not completely collapse. It did not lose every key level and turn into dead money. It built structure. It respected support better than many other names. It gave the impression that institutions were not in a rush to abandon it. That is the sort of action you want to see. Not random spikes, not wild one-day reversals, not social media noise. Structure. And a stock like that becomes even more interesting when the broader market is still struggling, because it tells you there may be genuine demand underneath it. At the time of this session, Comfort Systems was still hovering near a very important area, and that is what makes it so useful as a watch list name. It is close enough to matter, strong enough to respect, and not so extended that it becomes impossible to manage if the market improves. As of the latest feed, FIX was around 1,434, still one of the more powerful price structures in this group. Now, does that automatically mean buy it right here? No, and that is exactly the point. In a market like this, even strong stocks need the market's permission. That is why I keep separating best names from safe entries. Those are not always the same thing. A stock can be one of the best names on your screen and still not be in the right moment if the market is trapped under resistance and the headline tape is unstable. That is a lesson people forget all the time. They fall in love with quality and forget timing. But quality without timing can still punish you. The second name worth talking about is Powell Industries. And this one matters for a different but related reason. If the AI build-out story continues, the power side of that story remains critical. You cannot keep expanding data capacity without solving how energy moves, how systems are managed, and how infrastructure keeps up with demand. So again, this is not the glamorous side of the trade. but it is the necessary side, and necessary can be powerful. Now, there is one detail here you absolutely have to understand. Powell started trading on a split-adjusted basis on April 6th after its 3-for-1 stock split. So whenever you compare the latest price with older raw charts or old day-to-day moves, you have to remember that the split changed the visual scale. The business did not suddenly shrink. The share count changed. That matters if you want to read the chart correctly and avoid drawing bad conclusions from bad comparisons. As of the latest feed, POWL was around 186.72 on that split-adjusted basis. Again, the exact number is not the real point here. The real point is that this stock still sits inside one of the stronger infrastructure themes in the market, even if it carries more volatility than some investors are comfortable with. And that brings up another important distinction. A good stock is not always an easy stock. Some names are powerful but volatile. Some names are fundamentally strong but technically noisy. Some names can absolutely work in a confirmed market, but still shake people out if entries are not clean. That is why selection matters. That is why position sizing matters. And that is why I do not want anyone treating this as a market where sloppiness gets rewarded. Now, outside the AI infrastructure group, there is another area quietly doing its job: discount retail. And I really want you to pay attention here, because when a market is full of mixed messages, the groups that work can tell you a lot about what investors are thinking beneath the surface. If discount retail is acting well, that can reflect a very specific kind of environment. Not panic, not euphoria, but caution. A world where consumers still spend, but think harder. A world where value matters more. A world where investors are willing to back companies that may benefit from pressure on the average shopper. That is why Burlington stands out. It is not just that the stock moved. It is that the setup had context. The group had context. The market mood had context. Burlington belongs to a segment that often gets more interesting when the economy feels a little uneven and when investors start looking beyond the obvious growth names. That is why it matters that Burlington, Ross, TJX, and similar names have kept showing relative strength. That is not random. That is information. As of the latest feed, Burlington was near 337.97, and that fits the broader point. This is a stock acting near highs while much of the market is still trying to prove itself. That does not guarantee anything, but it absolutely earns attention. And let me pause right here for something important. If any of you watching are actually doing well right now, whether in stocks, business, trading, freelancing, or life in general, share a little of that in the comments. It genuinely helps other people. Sometimes one real story from a real person can lift the morale of hundreds of silent viewers who are trying to get their confidence back. Now back to the market, because there is one more layer here that people are not discussing carefully enough. Sector signals are mixed, very mixed. And when sector signals are mixed, simple narratives stop working. If this were a clean risk-on move, you would expect one kind of leadership. If this were a clean risk-off move, you would expect another. But what happens when both defensive behavior and selective growth behavior show up at the same time? That is when the market starts looking like it is arguing with itself. And that is a very good way to describe this tape. You have areas tied to caution doing well. You have parts of the chip trade trying to recover. You have AI infrastructure refusing to break. You have retailers acting better than expected. You have gold softening, even while the geopolitical backdrop remains tense. You have oil elevated. You have yields not exploding. You have indexes rising, but not in a way that fully resolves the risk. That is not a clean message. That is cross-current behavior. And cross-current behavior is where a lot of traders get chopped up, because they keep trying to force a single explanation onto a market that is still processing several competing realities at once. Now, semiconductors are especially interesting here, because if you want to talk about leadership potential, you cannot ignore chips. But if you want to talk about discipline, you also cannot ignore the fact that chip exposure has still been fighting with resistance. The broad semiconductor ETF has improved, yes. It has bounced, yes. It has kept people watching that 400 area very closely, yes. But the real issue is not whether it bounced. The real issue is whether it can clear key resistance decisively and then stay there. Because there is a big difference between recovering and ready. And that distinction is exactly what a lot of people blur when they get excited. As of the latest feed, SMH was around 395.98. That tells you the group is right there, close enough to matter, close enough to tempt people, but still near a level that needs respect. It is not hard to imagine strength continuing from here. It is also not hard to imagine another rejection if the broader market loses traction. And this is where I want to ask you something. What matters more to you right now? The fact that the indexes are green, or the fact that so many important groups are still sitting just below major proof levels? Because that answer says a lot about how you think. If you are only reacting to green closes, this market can fool you. If you are focusing on whether price can actually push through meaningful resistance and hold it, you are thinking at a higher level. That is the level that matters now. Let's also talk about the Russell 2000 for a moment, because small caps have quietly been one of the more interesting parts of this whole picture. They have not been spectacular. They have not delivered some breathtaking breakout. But relative to the bigger indexes, they have looked more stable in this rebound attempt. That is worth noting. Why? Because relative strength in small caps can sometimes tell you the market is broadening. It can also simply tell you that investors are rotating into areas that were previously left behind. Either way, it gives you another clue that this is not just a mega cap story. And that matters if you are trying to judge the quality of the rebound instead of just the headline result. The latest feed had IWM around 252.36, again reinforcing the idea that small caps have not been asleep here. They are participating. The question is whether they can keep doing it if the broader tape runs into fresh pressure. Now let's come back to the macro trio that keeps sitting over this market like a cloud: oil, yields, and gold. Oil first. Oil settled above $112 a barrel. That is not background noise. That is not some tiny side detail. That is a real macro variable, especially in a market already sensitive to inflation and geopolitics. Elevated energy costs can ripple through sentiment, inflation expectations, transportation, margins, and consumer behavior. So when stocks rise while oil stays up there, you should notice that tension. Second, yields. The 10-year Treasury yield was around 4.341%. That is important because if yields had sharply jumped on top of everything else, the market would have had another problem to absorb. But they were relatively steady. That does not fix the market. It just means one obvious pressure point did not get dramatically worse on Monday. Third, gold. Spot gold eased about 0.42% to roughly $4,656 an ounce. That is interesting, because if fear were dominating in a straight line, some people would have expected a cleaner rush into gold. Instead, the signal stayed mixed, which fits the bigger pattern we have already been talking about. This market is not sending one clean message right now. And when markets stop sending clean messages, that is when people start inventing certainty. Do not do that. Respect the mixed picture. Now, another quick thing, because a lot of you ask for fast updates during the day. The WhatsApp channel link is below, and if you want the quicker alerts, extra notes, and the smaller market updates that do not always make it into full videos, that is where you should be. It is the easiest way to stay close to the flow without waiting for the next full upload. And while we are on that point, by the time you are watching this, the members-only video should already be live. If you want all the key updates collected in one place and want the deeper version of this analysis, join the membership and watch that video as well. That is where I can go more in depth for the people who are seriously following every move, not just casually checking headlines. Now, here's what I think many viewers still underestimate. The best setups do not remove market risk. They only improve your odds if the market cooperates. That is it. This is why I keep pushing watch lists right now. Because if the market truly confirms, some names are not going to sit around politely waiting for everyone to feel comfortable. They will move, fast. And if you have not done the work ahead of time, you will either chase badly or miss them completely. That is the game. Preparation before confirmation, not excitement before confirmation. And since some of you always want the most direct answer possible, here it is. Do I think there are enough good-looking stocks to stay engaged? Yes. Do I think this market has fully earned aggressive exposure? No. Do I think the rebound attempt is real enough to respect? Yes. Do I think it is mature enough to trust blindly? No. Do I think leadership is showing itself? Yes. Do I think headlines can still derail the whole thing quickly? Absolutely. That is the balance. And if you can hold both sides of that truth in your mind at the same time, you are already thinking more clearly than most people. Now, let's talk about one more detail that often separates better investors from emotional ones. The emotional trader wants the market to become simple. The better investor accepts that sometimes it stays complicated. And when the market stays complicated, the job is not to force a story. The job is to identify what is actually acting best, where risk is still sitting, and what proof is still missing. That is what we are doing here. Proof still missing. A stronger confirmation day. Proof still missing. Cleaner clearance of major resistance. Proof still missing. A broader market move that looks less dependent on every new geopolitical whisper. But there is also proof already visible. Some leadership names are acting well. Proof already visible. AI infrastructure has not disappeared. Proof already visible. Discount retail is doing more than just surviving. Proof already visible. Small caps are not dead weight right now. That is enough to stay alert, not enough to get careless. Now let me ask you another question for the comments. If this market does confirm in the next few sessions, which area do you trust more from here? AI infrastructure, semiconductors, or discount retail? I want to know where your conviction is because this is exactly the kind of moment where leadership preferences start to reveal a lot. And again, if any of you have had a real success recently, even something small, share it below. A profitable trade, a new client, a promotion, paying off debt, learning a skill, recovering from a setback, anything. The comment section should not only be analysis. Sometimes it should be momentum for the people watching quietly in the background. Now let's pull everything together. This was a decent day, not a decisive day. The indexes rose, but the move was still modest. The holiday-thinned backdrop makes the green close useful, but not fully convincing. The S&P 500 and Nasdaq improved, but the market still needs more than a simple bounce. Oil stayed high, yields stayed contained, gold softened. Small caps looked relatively better. AI infrastructure kept giving investors names to watch. Discount retail kept proving that leadership is not limited to one obvious theme. And the whole market remained stuck in that uncomfortable place between this could be the start of something and this could still fail at resistance. That is the truth. Not as dramatic as permabulls want. Not as bearish as doom traders want. Just the truth. So what do you do with that truth? You stay sharp. You do not overbet. You map your best names. You watch how the indexes behave near the next technical tests. You pay attention to whether strength broadens or narrows. You keep one eye on headlines, because pretending they do not matter would be foolish. And most of all, you remember that in markets like this, patience is not weakness. Patience is position. Patience is information. Patience is sometimes the edge itself. Because the moment the market finally does make up its mind, the best opportunities often stop looking easy to everyone at once. By then, the groundwork has already been done by the people who stayed focused while everyone else kept trying to predict every headline. That is the goal here. Not to sound smart after the fact. To be ready before the next real move. One more thing. Because some viewers like to track the market through the big liquid ETFs rather than the indexes themselves. The latest feed had SPY around 658.93, QQQ near 588.50, and GLD around 427.65. I am mentioning those not because the exact tick matters more than everything else, but because they reflect the same message we have been breaking down all video long. Broad equities are improving, tech is trying to lead, and gold is not exactly screaming panic. That is a useful combination to watch, but again, it is not a perfect confirmation signal by itself. It simply tells you that the rebound is still breathing. Nothing more, nothing less. And that is why the next test matters so much. If buyers can build on this and push through the next ceiling, the tone changes fast. If they stall here, all this green can start looking like a pause inside a still uncertain market rather than the start of a clean new leg higher. That is the line investors have to respect right now. And if you were wondering whether this kind of careful posture is boring, good. Boring is usually where serious money gets protected. The loud part comes later. The patient part comes first. That is what this market is demanding right now. Not panic, not FOMO, but controlled attention and clean decision-making. From you. So stay close, subscribe if you have not done it yet, join the WhatsApp channel for faster updates, and check the members-only video if you want the deeper version of what is happening behind today's close. Because this market is trying to say something. It just has not said it clearly yet. And that is exactly why you need to keep listening.